Hey, Brian Stevens here with the National Real Estate Post and Mortgage Shots, and today we're going to be speaking with Dave Stevens, who is the current president of the Mortgage Bankers Association and has been so since May 2011. And prior to that, he was a U.S. Assistant Secretary over at HUD, and prior to that, he was a loan officer just like all of us. How are you doing today? Thanks for being here.
Good to see you, Brian. How's everything?
Good, good. Hey, one thing I wanted to talk to you about, and we had a little bit of a conversation about this before. I shot a video of a town hall meeting that Secretary Clinton was in, and I felt like there was a certain level of manipulation in terms of what the message is with regards to mortgage lending. In short, she was basing approvals and denials on race factors, but not really considering the extenuating circumstances that really lead to a higher level of denials for minorities. Can you speak to that for a moment?
Yeah, the funny thing is we've been trying for months now to get any of the candidates to talk about housing, and we finally got it. Just wasn't the way we wanted it. As I think most of you are aware, Secretary Clinton actually put out a formal housing platform, which is the first of any presidential candidate to do so. Unfortunately, during the process, when you're running for office and you got all these issues going on, you're running to be president of the United States, you don't necessarily spend a whole lot of time in the details. You're looking for policy positions that can strike a chord with the base that you're trying to get to support you. She certainly did that. Look, if you look at the Federal Reserve Bulletin that came out in November of 2015, it's a bulletin available on the internet. And it covers the HMDA data that was reported for the year 2014. And in there, it just gives in the tables the denial rates for all the various ethnicities for purchase transactions. A lot of other tables in there as well, but that's one of the tables. And, technically she's right. Denial rates for minorities are higher than denial rates for white non-Hispanics. Unfortunately, what she fails to look at is the why question. So FICO distribution, relative down payment. I mean, that was a large Latino audience in that town hall, and the individual asking the question was Hispanic. For the Latino community, that's a younger demographic. White non-Hispanics are older, so you tend to have more equity, more cash as you get older, so you can put larger down payments down. So if you look at the first-time home buyer populations today, a lot more Hispanics, fewer white non-Hispanics. And so when you look at purchase transactions over the last year, whites had bigger loan balances, larger down payments. Hispanics were a lot of the first-time homebuyer population. It is a demographic problem at the outset, but there's also a difference in her comment about African-American borrowers' denial rates. FICO scores, unfortunately, tend to be lower for various demographic groups over others. So when you isolate for those elements, you eliminate a lot of those differences that she failed to cover in a simple data point coming from a HMDA database, most likely from the Federal Reserve. The other thing I would just say, Brian, is it was interesting the follow-up question that individual, if they watched your video that you posted, followed up with, I just went through a loan application. It was really hard. It took forever. And she said, we're going to stop that too and make lenders make it easier on you. We'd love her help. We're all living in a world where the qualified mortgage rule requires us to do a whole lot of things that eliminate any opportunity to use judgment. And if you're a self-employed borrower, you have any kind of story to tell about your life, we all know how hard it is to get that loan approved and how much additional documentation is used. We've gone from a period where, well before the recession and before all the crazy loan products, we were able to actually use common sense and judgment to decide what was a good borrower. Unfortunately, the bad period that led to the housing recession has resulted in rules that don't allow that anymore. We've lost our way. We need to somehow find a way to get back where we can provide more creditworthy borrowers loans without worried about, legal interference or False Claims Act violations or enforcement acts from an agency. We have a long way to go there. But yeah, unfortunately for that statement, she's right, but she's also wrong, and it's where the detail matters. We're going to work closely to get that information to her campaign, and we've been back and forth with some of her campaign staff already today on the subject.
But what was implied there is that they weren't getting loans, or loans are more difficult because of their ethnicity, and that statement alone is patently wrong. I mean, and if we had a large Hispanic community there who was at this town hall, it felt to me like it was a little politically expedient. And when you have that type of vitriol, it becomes very divisive in nature, don't you think?
Yeah, absolutely, Brian. And you and I have talked about this, and look, the political landscape, all the candidates are appealing to the base that they think needs to be elected. I was watching an interview with Donald Trump this morning on, I forgot, one of the news shows, and they were asking if he's going to soften his tone and become more thoughtful in his responses. And he replied with something like, I will probably do that at some point, but right now, as I march to try to win the nomination of my party, the audience seems to like what I'm saying, so I'm going to stick with it. And in that regard, I think what you get out of any of the candidates at this point in time is rhetoric that appeals to what they consider to be their base. And I think for Senator Clinton, particularly when she's up against a Bernie Sanders, who is clearly very populist, really vitriolic against Wall Street and the financial services industry, she's having to veer in that direction. Whether she believes it or to that extreme, we will find out further as we go forward. But there is politics at play here, and I think, unfortunately, that makes us all a little ill that this process is occurring. But it's divisive. But nevertheless, I think that's part of what was in that dialogue in that speech.
Okay, so speaking of bases, I think by and large the lending and real estate base, a very large voting bloc in this country, feel that the Consumer Financial Protection Bureau, the CFPB, has overstepped its authority. And I want to talk about a couple of those cases in a moment. But I think a lot of people in the lending community are concerned that a Clinton presidency is only going to embolden the CFPB to go down a road that we believe to be not only harmful to lenders, but also harmful to consumers. Most importantly, the unintended consequences of these actions right now are the most harmful to the underserved communities. How would you respond to that?
Well, look, I have to be careful here. I think there's a devil you know versus the devil you don't know. I think that many of the hardworking people at the Bureau, who I've known, some of his key staff once worked for me in previous companies, I think there are many who are trying to do the right thing, to put protections in place, but get the balance right. I think, on the other hand, there's an enforcement regime that views enforcement to an extreme. And, it relates to your previous point. Lenders want to lend. If a lender is not doing a loan, it's because likely either the product isn't available, it's illegal, or there's unreasoned fear about putback, about False Claims Act, about enforcement based on what they perceive to be risk to their institution. So, look, there are loans that shouldn't have been done pre-recession, and the Bureau is an outcropping of that. We can all reflect back and say, the fast and easy, negam, 100% finance, no-doc loan probably was not a good idea. And we recognize those things, but I think our industry has actually gone a long way to fix our problems.
Right.
And what's left here is a very responsible, really quality control-focused industry that wants to do as many loans for qualified borrowers as possible. I think the Bureau is dancing along a very thin line here of creating policies that actually help protect consumers, which we need to make sure is in place. And I recognize that, and I think they've done some valuable work there. But at the same time, not creating an environment of fear that's based on not knowing what the rules are, not knowing specifics about, marketing and service agreements, or under the know before you owe rule, how do I disclose the date? Is it West Pacific Standard Time or Eastern Standard Time? I mean, there's a lot of nuance here that the Bureau could go a lot further to provide clarity to the industry, so we know we're playing within the guidelines that are out there. So I wouldn't necessarily call it overstepping their line. There is no line for them at this, in a relative sense. But I do think they're falling short in the one area of this clarity concern that we've constantly tried to address with the Bureau, because we all want to operate safely and soundly. We want to serve our communities, do as many loans as possible for qualified families, but we can't do so at the expense of risking our entire companies. And when you have vagueness in the policies themselves, and then finding out through an enforcement action that you shouldn't have been doing that when the rule wasn't clear in the first place.
Right.
That's where this thing goes upside down. That's where we need to all be really conscious and diligent to remind the Bureau of that.
So let me ask you about this. I have two more points I want to get to. But in particular with the case with Ally, we saw the immediate past CEO said a bunch of really strong language, opinions and words about what the Bureau had done to them or is doing with them right now. And then you have the case of PHH. Now with Ally Financial, we have an algorithm that was put forward that has been proven to be fatally flawed, yet the Bureau continued to go forward with their punitive actions with them. In the case of PHH, we had a fine that was levied, and then we had the Bureau come in and say, well, that's not good enough, and raised it by over $100 billion. Are those not cases of the Bureau overstepping their boundaries?
Well, look, I think it's really impossible for all of us to necessarily know all the details of the settlement that existed with Ally or any of the other large financial institutions that have settled, and small financial institutions and lenders that have settled with the Bureau. Here's my fundamental concern is that until you challenge these rules, these actions, rather than settle, they will continue to occur. And I think that's the same for the Bureau as it is for the Department of Justice with the False Claims Act cases that are going on.
Right.
PHH is a different case, right? PHH is fighting this in the courts. And that's their case is entirely different from the Ally case. In terms of what they settled for. But, it's really difficult to tell a regulator amidst all of these settlements that come out with press statements about terrible wrongdoings by these institutions that they're right or wrong when you haven't actually been able to go through the details of the case and see it fought out in the courts. Today we have two cases that are being challenged in the courts. One is the PHH case with the CFPB, and we have the Quicken Loans case with the Department of Justice. And my own personal hope is that they run their course and not end up settling prior to determining through the courts, because if you settle, we never are able to test the validity of any of these laws. And it's a tough one because I've spoken to CEOs of CFPB enforcement actions who would call me and talk through their decision-making process of settling versus fighting it. And if you're a CEO of an independent mortgage banker firm accused of whatever it is, and you believe you're right, you talk to your legal advisors, who are sometimes the best attorneys in the country, and their advice is, we can win. We believe we have a 65% chance of winning or a 70% chance of winning. That CEO has to decide, do I want to take the 30% risk of losing my company, losing my employees, and losing my viability as an organization? So. It is really an ugly process. I think the way you solve these things is going back to the points that I continue to argue. One is test them in the courts, and hopefully you get a couple cases to go through and prevail. But secondly, demand that these regulators give greater clarity around your obligations to perform, because, in the PHH case, they were operating under the assumptions of an authoritative letter that had been written by a FHA commissioner under the Clinton administration, Nick Ratsinas, that they thought they were abiding by in the structure of their captive, and that turned out to be something that was overturned. And so all we've learned from that process is don't trust the letter to last over the test of time.
Right.
We need the regulators to formally publish rules and guidance with specificity in a formal way, not an informal way, so that lenders can operate within the boundaries required of them and serve the housing market. Right now, this confusion is putting the entire industry at risk, and it's forcing lenders to walk away from loan programs altogether because they are not certain they can operate safely and soundly.
So you were bringing up the case with Quicken a couple of moments ago. I believe it's with HUD and the DOJ. We just saw, I think it was Bank of America who came out with a 97% LTV deal with Fannie Mae. I think the idea behind that is they want to get away from HUD. Quicken wants to get away from HUD. It looks like a lot of lenders right now are pulling away from HUD and FHA loans because of concerns over past and possibly future punitive actions. Is HUD making a mistake here? Is this a bonehead mistake on their part?
Bonehead. Yeah, I think my great fear is that this amazing institution that was created in 1934 during the Depression to provide liquidities to families across the country originally through Title I lending, but ultimately through mortgage loans, is at risk. And yeah, I do believe that the announcement that Bank of America made, and you're going to hear another one here, I think, shortly, of a similar concept, is because lenders trust the process with Fannie Mae and Freddie Mac now more than they do FHA. And I want to highlight the fact that, as you know, we started that rep and warrant clarity process with the MBA, with the working group and the FHFA and both Freddie and Fannie. With a term sheet and negotiations, we were able to establish what constitutes a material violation of your rep and warrant, remedies to repair those reps and warrants. Right. What are the various ways to resolve errors in loan files? And we've completed that process to the point where what began with many years ago just putbacks and concerns about the GSE rep and warrant process to now confidence in the GSEs. That needs to be repeated at FHA. FHA needs to provide a loan level certification that an employee is signing of a company that doesn't hold them accountable for any and all errors in a loan file, because some are material, some are clerical, and can be fixed and are not material to the decision. And we need to separate those. And you're seeing, starting with the major lenders, a lot of trumpeting about their exiting of the FHA program, or at minimum reducing significantly their role in the program. And you and I both know, particularly, in Sacramento, California, in areas where their average loan sizes, maybe not as much today, but once upon a time were very low in this big FHA market.
Oh, it still is, yeah.
So that's the entry point for home ownership. And you get enough lenders moving away from that program, we're going to kill housing in this country. FHA has an obligation to resolve this.
I do have one last question. I lied. I got one more. So one thing that we're seeing right now is there's a lot of subprime loans that are coming back into the industry. Call them what you will. Some people call FHA a subprime loan, but a lot of subprime lenders are coming in and offering products, alternative products that all have the ability to repay. Some of the guidelines I found a little shocking, but I think it's good for the market. Do you have an opinion on the reintroduction of subprime loans right now? Is it good or bad for the industry? And should lenders in particular be concerned to start to take these on? Because that's what I'm seeing.
The non-QM space concerns me because we framed the QM space so narrowly. So if you're a borrower who's got self-employed income through multiple jobs, I'm not going to go through the various stories,
sure,
but
sure.
There are so many of them where you are boxed out of getting a conventional conforming loan through a GSE or through the FHA, and your only alternative for home ownership is some alternative product that comes with a significantly higher interest rate, 8-9%, which does exist right now in the marketplace. It's not a matter of choice. It's a matter of, a decision whether you want to own a home or not. And this is the only option because the rest of the rules have been made so narrow that we can't operate. I'm not a big fan of bringing back the bad products of the past. So I'm hoping sustainability and ability to repay sort of remains as core concepts in what we do. But I am seeing 100% finance programs available right now. I'm seeing a lot more introductions of adjustable rate programs and some alternative approaches to credit and documentation that are beginning to come back in. And I think all of us have an obligation as an industry to be careful not to reopen wounds that could put us all under attack and all under speculation by policymakers. Look, whether we like it or not, the rest of the world doesn't understand all the change that our industry has gone through and a massive amount of expense we're spending on quality control and compliance to operate safely and soundly. They don't see that part of it. They still hear Bernie Sanders railing from the microphone about Wall Street, quote unquote, which I think throws everybody in there. And we got to make sure as we expand credit that we don't end up creating disparate impacts, fair lending opportunities for new forms of legal action to come against the industry. So anybody who's participating in any of these new programs, I think you got to think about the long game, not the short game. A few points in revenue to make this month's income is not worth sacrificing your company. So I just think we ought to be careful about it.
David Stevens, thank you so much.
Thanks, Brian.
Hey, subscribe. Come on, help a guy out.